Gold would have to be $8,500 to be an eightfold move from where it bottomed in 2015. And silver's, let's say, at 3% or something. Okay. If we match what happened in the final couple quarters of the 2010-11 bull, then the green arrow says we're going to exceed 100 in the next couple quarters. If you match what happened in 1980, it was like a summer of 79 through 80, that move, again, a couple quarters, you can go to about 200. Okay, now, sounds crazy, right? Okay, maybe it is.
And gold, let's say we have a year and a half left. We started when gold broke through 2,000. Now we've almost doubled to 4,000. And now what if it goes to 6 and 8? What if it peaks at 8 in June of 2026? And that's it.
Silver is approaching a point in the market where history suggests moves can become violent and transformational. Looking back at the great bull markets of 1980 and 2011, both experienced rapid price rises in compressed bursts of just a few quarters, transitioning from steady uptrends into vertical acceleration. Today, silver remains well below its historical highs, especially when measured in real dollar terms. At the same time, gold, copper, and other commodities have surpassed previous peaks. This creates a situation that appears less stable and more like a market error waiting to be corrected. When silver finally realigns, it is unlikely to do so gradually. It could reprice sharply, leaving those unprepared on the sidelines. MichaelOliver, a seasoned technical analyst known for his momentum studies, has highlighted how the gold-to-silver ratio now indicates that silver is poised to break into a new reality. Alongside him, DavidMorgan, long regarded as one of the most respected silver market commentators, points out that structural supply shortages, rising industrial demand, and the inability to increase mine output quickly make silver uniquely positioned. Both stress that corrections will occur, but the long-term trajectory suggests triple-digit silver is no longer a distant dream. Silver's undervaluation has persisted too long, and when markets adjust such imbalances, the results are both jolting and decisive. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Copper's above its 2011 high and its 1980 high. Silver made two highs roughly around 50 in 1980 and 2011, okay. Gold's above its 2011 high. Heck, I can find you a bunch of base metals that are above their 2011 high, yet silver's a dog and needs to stay in the hole, right? Okay. There's a mistake been made. Markets often make excessive mistakes, both upside excess, bubbles, so forth. And then when they break, people say, why did it happen? Well, it happened because of what it did, not because of what's going to happen to it, but what it did already. That was an error. An investment error, an analyst error over the years, they underestimated, overestimated. Silver's been capped in real dollar terms so low, because if you take, if silver was $50 in 1980 and was near $50 in 2011, and it's still below there now, in real dollar terms, remember the dollar degrades because it increases in supply about 90% every decade. The quantity of paper, okay. Therefore, it's sort of a junior version of the Weimar Republic, okay. Not quite as bad as Venezuela, but it's ongoing and it persistent. That's why gold continues up, over the decades. In 1980, what was it? Couple hundred, $800. Okay, now it's 3,500, 3,900. Excuse me. Silver's way behind. Okay, now the question is it justified or is it not? And, fundamentally, we can make arguments that, no, it's fully unjustified. It should be a lot higher. We don't pay attention to that. Yeah, there are fundamental reasons why it should be. We pay attention to its technicals. And we've observed, there's a chart we want to show. It's a ratio scaled price chart, meaning log scale, where it's not arithmetic, $10 to 20 is the same as 20 to 40. Instead, it's, going from 10 to 100 is the same as 100 to 1,000 in terms of ratio. Okay. Here's 50 years of silver history. And the first, on the left side, you see the peak in 1980 where it got up to $50. And what we've done there is we've marked the spot about 2 quarters or 5 to 6 months before its actual peak, where it went vertical. Which rather, it had been going up for a couple years incrementally, and then suddenly went berserk. Okay. And it was all compressed in a matter of a couple quarters. Okay. We marked that spot with the red horizontal arrow where it began at the top at $50, the red horizontal. And then we put an arrow to measure the distance, logarithmic scaled. Okay. Let's go over to 2011 now. That's the green arrow. And that's where it started with the lower horizontal green line and ended at $50 again with the green horizontal upper line. And we marked the arrow to show the distance of the logarithmic scale to swing that again occurred in a matter of a couple quarters. Why did suddenly, in those two situations, silver had been a bull market for a couple years, more than that even in the 2010 situation, did it go berserk? Why did it do that? Because it was already in an uptrend. It wasn't like, oh, it just broke out into an uptrend. No, it was already in an uptrend. We found an argument that we make that we're in the same position right now prior to the berserk vertical move. If at current price levels, which is the bottom of both the arrows on the extreme right, the red arrow and the green arrow, if we match what happened in the final couple quarters of the 2010-11 bull, then the green arrow says we're going to exceed 100 in the next couple quarters. If you match what happened in 1980, it was like a summer of 79 through 80, that move, again, a couple quarters, you could go to about 200. Okay, now, sounds crazy, right? Okay, maybe it is. I'm not going to predict except to say it too will advance more sharply once this spread breaks out. It just won't be advancing anywhere like silver. And if you go back and look at those two prior bull markets, the 1980 peak in gold, the 2011 peak in gold, they both were 8-fold multiple moves from the prior bear low over a different span of time, but both were 8-fold dimension moves in price. Gold would have to be $8,500 to be an 8-fold move from where it bottomed in 2015. So you want to do the percent of where silver might be if gold goes to 8,000. And silver's, let's say, at 3% or something. Okay, anyway. So there's a whole bunch of factors here, but I think the key factor now for silver and gold, because gold will go up too. When silver accelerates, gold will also go up, but it just won't accelerate to the degree that silver will. That's the key technical to watch right now if you're involved in these markets. I know when people look at their daily price charts and weekly and monthly, they say, oh my gosh, I got to take profits. It's been too much, too easy. It doesn't even compare to these situations. In fact, it's on the doorstep of them. We know when we look at the annual production output of silver and the annual industrial consumption, for example, it's tight. It's been tight for several years now. It's not improving. There's no excess. And yet demand is rising because solar energy production, especially from the Chinese, they need silver in the solar panels, the voltaic cells. Silver is also a microscopic but ever-present use in virtually all the technology like people like to rave about, AI and so forth. There's silver in there. It's a great conductor. One of the problems is once you put it in there, it can't be recycled out because it's such a trivial amount that it's hard to recycle out. It's not like you can pull out an ounce of silver. You know what I mean? So recycling silver is not really viable. And the other issue is when a given market goes up in price, it entices what? More production of that product, of that commodity. Like grain goes up, people produce more wheat and soybeans and corn. Or if copper goes up, they're enticed to produce more copper. Okay. The problem with silver is most of its production doesn't come from silver mines, which would be directly impacted by rising silver. They would be enticed to up their production. It comes from zinc, lead mining, copper mining. So those miners aren't particularly motivated by a sharp increase in silver because it's marginal to their overall production. So you can take silver up dramatically in price and it's not going to cause a dramatic increase in its production. That's sort of a unique situation. But all these factors are there. They've been there. It's just finally silver, to the extent that it has made a mistake. Many markets do this. Price too low for too long, too high for too long. When they correct the mistake, it's usually very jolting. If you're not there, you miss it. A lot of these short-term metrics, like looking at the CFTC readings of the who owns what and how much, and whether there's somebody's trying to repress silver or not, they don't matter. The real picture is the bigger issue that we've been talking about, is that you've got an asset here that is in no way priced fairly compared to gold, compared to copper even, okay. And if it's made a mistake, as we argue it has, and it triggers key technicals, and we think that technical now is that ratio between silver and gold, the spread relationship. It's telling you, okay, I made a mistake, I'm going to correct it. Oh, sure, there'll be headlines along the way that people will think are the causative factors, but they're not. They're just simply exposing what already existed or some new element that comes into play. But the real issue is the mega issue we've been talking about. It's underpriced in reality terms, in relation to the value of the dollar, the quantity of money units, in relation to the price of gold, et cetera, et cetera. And when it makes up for that mistake, it's going to do it joltingly. And we're arguing that highly likely when that spread breaks out, expect probably with a correction in the middle. So don't assume it's just here to there. It's here to halfway and then there. But in the next 6 months, silver could leave the page and be in a new reality. Sure, you can have major drops in silver, but they're not coming back to $30 or $50. You might be at 150 or 200 and have a correction back to 125. No, you don't want to be there then. But the key is to catch the move into the new reality. And I think we're on the doorstep. We thought that might be a target. Our assumption now is at least 100 once the spread breaks out, and I think we're on the doorstep. We cover that week by week, day by day sometimes. That you're going to gush to 100 to 200, and I'm not sure which, but this 60-70 we had is that's out the window. We've altered that view.
Gold today is acting less like a simple asset and more like a barometer of global financial conditions. Unlike a thermometer that measures the present, a barometer signals the storm that lies ahead. Its accelerating price action suggests the markets are entering the most critical stage of this bull run. Historically, the majority of gains often occur in the final stretch of a cycle, fast, concentrated, and driven by panic buying and fear of missing out. A doubling or tripling of price in a short span of time is not an exaggeration when measured against past precedents in metals, real estate, and equities. Silver is increasingly tied to this dynamic. Industrial demand now accounts for nearly 2/3 of total usage, compared with just over a third a few decades ago. Supply has grown, but not nearly enough to meet both industrial and investment flows. Recent years have already seen deficits bridged only by tapping above-ground inventories, and the outlook suggests this imbalance will persist for decades. As gold climbs beyond levels once thought unreachable, silver stands to attract even greater attention as the affordable alternative with the potential to accelerate faster and further. Let's get back to the interview.
Gold is a barometer, not a thermometer. So if anyone knows anything about a barometer, if you're a pilot or a seaman, and and people generally know, but a barometer is a forecaster of what the weather ahead looks like. And if it gets a slight move, you'll look and say, okay, well, maybe, we're going to have some clouds or whatever. But when it really moves, which is what's happening, that means, big storm ahead. I'm going to cancel my flight plans. I'm getting my boat back in the harbor. That's what it means. And that's what we're seeing right now. We're seeing an acceleration. We're in the acceleration phase. As you know, and I've kind of been poked at over the years, and it's fine. I mean, I can take it. But, I've said, really, Jeff Christian's the first one that said it to me, was that 90% of the move comes in the last 10% of the time. And I've said that over and over and over. It's not exactly 90 and it's not exactly 10. But the point is that in all markets, not just the metals markets, but in the real estate market, the stock market, you get this acceleration move at the end of the bull market. And that's where you start getting the greatest capital appreciation in the least amount of time. So for this market, as a hypothetical, we might have a year and a half left and gold go, let's say we have a year and a half left and we started when gold broke through 2000. Now we've almost doubled to 4,000. And now what if it goes to 6 and 8? What if it peaks at 8 in June of 2026? And that's it. I'm not saying that is it. I'm just giving a hypothetical. But you get my point. So there'll be people that come in late to the party that buy gold at 42, if I'm right, okay? So we have to make the preface that this is correct. And is it? We do not know. But assuming that it is something like that, you get it at $4,200 gold and you get out at $5,200 gold and you're leveraged 10 to 1 in the futures market, that's retirement money. So you've made more money in, let's say 8 months than people that have held gold for 30 years or something. Not that I'm judging good or bad. I'm just trying to explain that the acceleration is when you kind of get this manic panic FOMO now that we talk about modality, where everybody wants to get into the gold market or silver market. Gold is the most negatively correlated asset to the stock market, and it is. And the stock market's going high and gold is going higher. What does that suggest? It suggests that when the stock market does go down, that gold's really going to rock. Because we are seeing two, I wouldn't say bubbles, but something that's rather contradictory. If the stock market's strong and gold is negatively correlated, you wouldn't expect gold to be doing well. Gold is setting new highs over and over and over, which is, in a way, if you understand what I just said, could be a little bit of a stomach-turning idea. Because if it's this strong now, what happens if we do get a failure in the stock market? Then what's going to happen? Yeah, if you go back 25 years, the silver market on an industrial side was 35% of the market. Now it's arguably 60%, maybe some say as high as 70%. You go back 25 years, we mined 550 million ounces of silver on an annual basis. Today, we mine 850 million ounces. So we're up 300 million ounces being mined annually, more than 25 years ago. And the ratio has gone from 35 to maybe almost double. So we are in a position where right now, according to Matt Watson, who does independent metals analysis, he's been on a few channels, very smart guy, does all the metals, put out a graph that I've shown publicly a few times, giving him credit, of course, that right now the industrial demand alone is going to take us into what Jim Dines called a natural corner. When you corner the market, you buy up all the available wheat or rice or corn or silver or whatever it is. Well, if industrial demand alone is going to eat up all the silver, counting jewelry and silverware, is then what happens if there's any investment demand? Well, it takes it beyond belief is what happens. And he has a curve, or actually a graph, I should say, that shows the last 4 years we've been basically in that deficit mode, where the only way to make supply and demand balance is by eating the above ground supply. Supply and demand have to meet every year. How does that happen? Well, we have enough of above ground supply to make up that delta, that difference. And that's happened again and again and again. And according to him, and I agree with him, it's happening for the next 25 years, because all that we know now, things change. Technology could change things. There's something out there that no one's aware of right now that could change this dynamic. But with all the information we have right now, we're flat on silver mining and recycling for the next 10 years at least. But demand keeps going higher and higher. Now, where I disagree with Matt is he shows a constant in investment demand of around 200 million ounces a year. I totally disagree with that, because as people start to see that barometer and there's a race into the metals, silver will actually take over gold and it will out-accelerate gold, because gold will get to a point where the average person can't buy an ounce of gold for 4,000, but they can buy a lot of silver for 40. And you're going to see that. That's what happened in 1979. But what happened in 79 was the United States alone. I remember you asked me at the beginning, what was my biggest worry, my biggest concern? And that is it's a worldwide phenomenon. So if you have the world looking at silver as more affordable than gold, it's not just the United States, and the US dollar is not trusted to the level that it once was. and you have a $7 trillion sitting on the sidelines in money markets, not knowing what to do, and you take 1% of 7 trillion, that's 70 billion, Daniela, which you know, and that represents about 2 years of total mining supply of silver. And if you don't think that 1% of that money is going to move into the metals and maybe 1% into the silver market, then I should throw away everything I've done for 40. You go from the British Empire, the pound sterling, which is a 92.5% silver. That's what a sterling is. Anyway, you go from Great Britain, United Kingdom having most of the gold and having most of the power, and then that transferred to the United States having most of the gold, most of the power. And for the last 25 years or more, we've seen the gold go from west to east, where China has most of the gold, most of the power. So from a very elementary look, all you have to do is follow the money, see where it's going, and you can make the conjecture that I made 20 years ago, that the dynamics are favoring China. China will become the monetary power of the world, and it will be leaving the West. And we'll have a lower standard of living in the West, and we'll have a higher standard of living in the East.
The broader market is entering a stage where narratives, capital flows, and investor psychology converge simultaneously. This is where momentum takes over from fundamentals, and price action itself becomes the driving force. History shows us that when confidence begins to shift, the move is rarely gradual. It is swift, emotional, and often far larger than anyone expects. For those watching closely, the signals are becoming clearer. The imbalance between supply and demand, the pace of capital rotation, and the underlying stress across the financial system all point in the same direction: acceleration. It is a moment to stay informed, disciplined, and prepared. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.